Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. You're listening to Destination Retirement. Thank you for joining us. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. If this is your first time, welcome. Hopefully you will find that everything we do is at the heart of being an educator and making sure we're providing you with actionable ideas, especially when it comes to your investment portfolio. We are a fiduciary, and clients and investors hire us to build hyper-personalized portfolios and customized portfolios. Everybody listening has a different, unique need for protection, for growth, for distribution, for future income, and cookie cutter portfolios, model portfolios that advisors use for every single client is just not going to cut it today. So if you're a return listener, welcome back. If you're catching this on the podcast, we do podcast every episode of the radio show. Welcome. And please send this on to anybody that you believe needs to hear our message. We're very passionate about helping investors lose less. It's really simple. If we lose less, ultimately, we will make more. So if you want to have an initial conversation, again, no question is too small. Anything related to IRAs, to 401ks, to tax reduction, to you feel your portfolio isn't being actively managed, just give Paige a call. Generally, we will set those up for the next week or two, and a convenient time for yourself, and certainly one that sets that works with our schedule. But the first call is very informational, and just kind of learn what you're looking for, what you like, what you don't like, what your concerns are, what your thoughts are on your current portfolio, and we'll address those questions on the initial call. We don't have any criteria to work with us. We hear an awful lot about that. Some people want $1 million. Some people want $5 million. Some people want whatever that number is. Our job is to make sure that if you want help, if you're open to help, whether you have $100,000 or whether you have $10 million, then you're somebody that is going to work well with us long term. So give Paige a call, 630-492-1912, 630-492-1912. You can also visit the website, kuhncp.com, kuhncp.com. And you can also set up some time on the website if you'd like to as well. So inflation is still hot. I think everybody knows that. Numbers this week came out and verified that. It's really interesting. If you strip out food and energy, then they're not quite as bad. But I think everybody listening, especially if you're driving, you know the importance of food and energy, especially in this market. I talk with my wife often about food and food prices, and she tells me that they're off the charts. Conceptually, I understand that because this is what I do as far as inflation, as far as managing money, as far as income planning, distribution planning, et cetera, et cetera. But when she provides examples, I'm just amazed. And I'm amazed at just the increase in food prices. And so you have to kind of equate that to, what is that going to do if you're in retirement? Obviously, that we want to keep your standard of living the same. But if we're seeing rapid inflation and it continues to rise, and many people like ourselves think that oil is going to go back up to $100 a barrel, we'll probably see price of gas increase significantly. And, I think, there is no end in sight for the increases that we're seeing in inflation, and the cost of living is dramatically increasing. And we're at a time in the market where, the markets are, increasingly high and valuations are high. And we look at where we've come from, and, we've seen tremendous growth in the market, and people that we're having conversations with, it used to be all about growth. My portfolio is not growing enough. It's not growing enough. And we meet with people who have, seven-figure portfolios, multiple seven-figure portfolios, and those that have, $100,000 portfolios that I don't think they recognize the lack of growth inside of their portfolio. We were working on a portfolio review for an investor the last couple of weeks. And I was, very, very surprised to see that, the total portfolio has grown less than 2%. And you're looking, that's year to date, and you're looking at the market, growing, north of 16%. And the advisor was charging a 1.25% fee on top of that. And, I wonder if investors pay as much attention as we do with when it comes to growth, because you look at a multiple seven-figure portfolio at 2% versus the less than 2% versus the market at 16. I mean, your delta there is to the market is $600,000-$700,000 of underperformance. I mean, it's just staggering. And so one of the reviews that we do when investors, are engaging us and learning more about our offering and learning more about what it is that we do, I think my job is to make sure that you have a very good understanding of initially, first and foremost, what you own. And let's look at the diversification. In this instance, it was, just stocks, equities, which were a mix of stocks and ETFs and mutual funds, which is mind-boggling to me that, anything over $100,000 would still, or advisors would still put in a portfolio of mutual funds and those fees, and then the advisory fees, and lack of transparency, lack of tax efficiency, lack of diversification. It's crazy, but so we're looking at a multiple seven-figure portfolio that had three asset classes: fixed income, cash, and equities. And the only way that client or that investor would make money is if the market goes up. And that's, I don't put the blame or the onus on the individual investor. I mean, they're not experts at this. I mean, educated, very smart in their field. And they rely on professionals to, have a very well diversified portfolio that can keep up with the market, that is cost effective, that is transparent, is tax efficient, et cetera, but it wasn't. And so our performance review is one of the first reports that we run for individuals, so individuals can get an idea of, are you keeping up with the market? Are you not keeping up with the market? Are you drastically underperforming the market? I mean, there's various degrees, right? I mean, if the market's up 16 and they're up 13 or they're up 10, I mean, okay, it is what it is, right? But to underperform, at that level with a major firm is just, shocking to me. So if you have any interest in, your current portfolio, if you don't know the benchmark of how it's doing, again, whether it's a 401k, IRA, taxable money, it really doesn't matter. Generally, we like to see over $100,000 for that report. We certainly can run that for you. So reach out to Paige, 630-492-1912, 630-492-1912, because inflation is sticky. And it's very, very sticky, and it's a challenge. And we're seeing, people who are, in that red zone, 10 years from retirement, and those that are certainly in retirement, they're very concerned and very, very concerned. And when you look at CD rates today, many individuals that we talk with, they have CD rates that are, they're just bought. Okay. And they're paying, only 4.5%. Under 5%. And I have to question, what in the world are we doing when we can get a money market rate that's paying between 5 and 5.5%? And a lot of people, view that as a great rate of return. And relatively speaking, if you look back over the last handful of years, I mean, it's great. I mean, when money markets are, next to nothing, and now they're at 5, 5.25%. I mean, that certainly is great, but we have to look at, is that keeping up with inflation after tax? And are we just eroding our purchasing power because yes, you think you're getting 5, but inflation is generally it is going to be much more than that if you're older. And you take into consideration medical costs, et cetera. So we're really just trading one risk for another. And so we have a lot of people that we're talking about. And as I mentioned earlier, we had a lot of people that were worried about growth. And now we have people that are really focused on protection. And in this industry, protection is a funny word. And, we look at protection different than many people. A lot of people will use insurance products, and there's not necessarily a whole lot wrong with that. I think when you look at insurance products and you look at the annuity space, I mean, there's only really one annuity that we'll use, and as most people know, annuities pay a commission, so the advisor gets a commission, and the longer that you commit to, generally the higher the commission is. But we like to use, if we're going to use a principal protection strategy, excuse me, we like to use, there's some very, very appealing 5-year, buckets today that are tied to the S&P. If you have an annuity, an index annuity, especially a variable annuity, of course, because of the cost, let us review it, because any annuity that was purchased prior to last year is priced with the old interest rate environment, and you're potentially giving up significant growth opportunity. And so we want to make sure that, we are having that conversation and helping you understand that, because we don't want to, we want you to get the most growth, obviously. I mean, anybody, there's so many strategies that can protect, but we want protect, but really growth. So when you look at protection, it really comes down to several buckets, and I want to spend some time on this today because, if you've listened to the show in the past, we do a lot of dual directional notes, and they're bank notes, and it may be right for you, it may not be right for you. There's a preliminary prospectus that, if you're considering, we can send you, completed prospectuses of past offerings. But they're really simple, and they're so competitive today, given where the market is at this current valuation. The one we just are doing tomorrow, or on Monday at Prices, actually was a Morgan Stanley note, and it was tied to the S&P 500 and the Russell 2000, and it was a 15-month note. So it's backed by Morgan Stanley, big bank, great credit. Generally we do JP Morgan, Morgan Stanley, UBS, the big banks, banks that are going to, staying power, fortress balance sheets, etc. But people don't understand that you can still make money when the markets are down. And that is so critical at current valuations. And so this last note we did was a 15-month note. It was just over 22% maximum growth. So over the next 15 months, if you're content with potentially making a max gain of 22%, then this is something that you want to look at. And I think you'd be very hard pressed to see the S&P or the Russell be up 22% from current values, current value, current rate, current pricing, in the S&P or the Russell over the next 15 months. But it could be. But most people are content with 22%. But here's what you get on the opposite sides. From 0 to negative 15%. So if the S&P or the Russell is down from 0 to negative 15%, you actually get the inverse return. So let's say the S&P is down 15. Well, you actually get positive 15. Let's say it's down 7. You get positive 7. Let's say it is down 8. You get positive 8. So if the S&P or the Russell, whichever is the least performing, is down 0 to negative 15, you actually get the inverse. So think about that. Maximum gain 22%, which most people are very, very content with that. And in all honesty, my guess is that, that'll be 100% of the return of whatever the market is. So that's your max gain. 0 to negative 15, especially going into an election year, you're still going to make money. You're still going to make money if the market's negative. From 0 to negative 15, you're going to actually make money. You're going to get the inverse return. And then if the S&P or the Russell, the least performing, is down more than 15, you start to see a negative return. All right. So if the S&P, let's say the S&P is down 20, well, you're down 5. Let's say it's down 16, well, you're down 1. So from, the very 0 to negative 15 is your buffer. Look at negative 15 as your 0. So when you look at these strategies, we call them defined outcome strategies. When you look at these types of strategies, we like a defined outcome strategy because we know what the rules are. We can craft a customized investment that we know what our max gain is, how we'll make money if the markets are down, and then, when do we start to lose money? And at these valuations, listen, there's no reason that everybody shouldn't consider these. Used to have 7 figures going back many years to invest in strategies like this. With the evolution of technology, et cetera, the minimum investment now is $1,000. Think about that, $1,000. So a couple risks, obviously, is the issuer. So this one's Morgan Stanley. What do you think about the bank? What do you think about the company? Obviously, great credit, and we're very comfortable with that. What about JP Morgan if they're issuing it? Obviously, you have to be very comfortable with it. So it's not like we want to go and, find XYZ Bank on the corner that has one branch. I mean, we're using companies that have fortress balance sheets, okay? But that is a big risk, and that is a big concern. So we want to make sure that it's a good company company that's been around, that has staying power, big, balance sheet that can handle, shocks in the market, et cetera. And then you have to consider, can you forego that money for 15 months? They are liquid, so you can't sell it, but we don't want to have to sell it, just because we don't know if we're going to make money or if we're going to lose money. So most people are content with 15 months. We do that for long-term capital gains purposes. If it's an IRA, we can look at a 12-month note. But the point is that these strategies need to make up a large bucket of your money potentially. And unfortunately, 99% of advisors have very limited knowledge when it comes to structured notes and bank notes. And it's a huge, huge space. And they just don't have access to them. And, we do. And we're independent. And so we can absolutely, positively create custom notes. Let's say 15% isn't enough for you. So we saw a 20% downside protection note. And for that trade-off, you only got 10% on the upside. But again, we want to make sure, because when it comes to investing, right, at current valuations, the markets are very, very fully valued in our opinion. And we have a lot of people who are sitting fully exposed. We see a lot of investors that are fully exposed to the downside of the market. And they have, or even worse, they've used fixed income bonds as a risk mitigator. And you look at what's happened to the bond market, worst 3-year period in history. And what's an advisor's answer to that? I mean, what? And so I think one of the things that we're very, very focused on is really truly showing you inside of your portfolio, your returns and your risk mitigation strategies. And most people don't have them. And candidly, that's why we capture the amount of business that we do, because we're bringing a service to the client. It is unique. It is different. There are very few advisors that I know of personally that incorporate defined outcome strategies to the extent that we do. Most don't. So we're here to help. If you have any interest and you want to learn more about those, give us a call, 630-492-1912, 630-492-1912. Visit the website, kuhncp.com, kuhncp.com. Tax reduction strategies and more on risk after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. My name is Robert Kuhn from Kuhn Capital Partners, president, founder, portfolio manager, et cetera, et cetera, et cetera. We are a fiduciary. Everything that we do is financial planning based. It's very important. A plan However, like we say, is not worth the paper it's written on if you're actually losing money. And I'm amazed how many people don't fully understand what is in their portfolio. And I don't fault you because this isn't your industry. I fault advisors for not crafting a portfolio that is, first off, actively managed and has downside protection strategies inside the portfolio. We call them DOS, defined outcome strategies that you know what the up, what the down, and how you can make money in positive and still make money in negative markets to a point. Those need to be included in a portfolio. No reason for them not to be, especially with the minimums only being $1,000. So it's don't look at that as, that's just the barrier of entry is very low. Unfortunately, most advisors are still not embraced defined outcome strategies. And I like strategies that you can make money in the markets when the markets are down, and those strategies exist. They should be part of a portfolio. And so we're here to help you x-ray your current portfolio, fees, growth, risk management strategies, etc. Really anything when it comes to your investment portfolio that you have questions on, we're here to help. So everybody has always said that we do lead with education. They like the fact that our job is to educate, not to tell you what you're doing is wrong. In this industry, unfortunately, you could have a 20% guaranteed bond backed by the government that's completely liquid, and you get 20% a year. And if an advisor didn't bring that idea to you, he's going to tell you why it's a bad idea. So we're not like that. A lot of conflicts of interest in this industry, and we're going to talk about some of those this segment. So give Paige a call. Let's have a conversation this week, 630-492-1912, 630-492-1912. If you're listening to the show and you're outside of the Chicago area, understand, please, that we can work with you. So we are expanding the reach of the show, and we are going to new markets. We're very, very happy about that. So if you are listening to this show, then we have representation and a team member in the area that we can work. And, one of the great things about COVID, I guess, if there is a good thing, is that you're now not defined with the advisor that you work with by geographical limitations. That is so important. We have a national client base. We love it. We love to get out and see clients, and when we do go outside the Chicago area, we can target the locations with a lot of our clients, so we can do our portfolio reviews, etc. But, so many people are tied to, well, who's closest? And that is a very bad way of looking at managing money. The way we want you to look at managing money is who generates positive returns in both up and down markets, and who can have strategies inside of a portfolio that you can make money even when the markets are down. So give Paige a call. Let's have an initial conversation, 630-492-1912, 630-492-1912. So was talking a lot about closet index funds, and I want to get to that here in a minute, but tax strategies. The most overlooked area of financial planning is tax reduction strategies that can reduce your taxes, can reduce your taxable income dramatically. If you have a trust, if you have a taxable account, which is just obviously non-IRA, non-401k type account, and you're in mutual funds and your account's over $100,000, I want you to stop and think. They're not tax efficient. You can actually see the markets go down and you can still pay a capital gain. So if you have over $100,000 and you have a taxable account, a trust account, et cetera, and you're in mutual funds, or if you're in index funds, and you really have to stop and ask why. Hidden fees, not transparent, not tax efficient. And so when we look at tax management, tax efficiency, and reducing taxable income, strategies exist today that can greatly reduce your taxable income. And we, to the tune of, if you invest $100,000, you can reduce your taxable income by up to $80,000. Think about that. $80,000 you can reduce your taxable income. Doesn't mean the investment's good. Doesn't mean the investment's bad. Doesn't mean that there's not risks. I mean, those are things that we have to certainly, talk about, that we have to share with you, every risk that we perceive and every reward. So don't think just because you get great tax reduction strategies that it's a great investment. There's some great ones and there's some terrible ones. But if you sold a building, if you sold a business, if you are a high wage earner and you want to reduce your taxes, strategies exist that can provide significant tax benefits. Again, $100,000 investment up to $85,000 generally in tax savings. So that, just think about how that offsets your taxable income. If you have significant money in an IRA and you want to convert it to a Roth, you're going to get hit with a tax bill. Well, what if we can mitigate, that tax bill entirely, and you can now, convert a future taxable asset to now an asset that, as long as you live within the parameters of a Roth, are future gains and growth. You don't pay any taxes on. So if you want to learn more about those strategies, we want to have a conversation with you. It's a niche of ours. It's an area that we're very passionate about. If you're a CPA listening and you want to go over those strategies for your clients, again, just give us a call, 630-492-1912, 630-492-1912, and we'll have that conversation. Closet index funds or closet index strategies. And what does that mean? Unfortunately, sometimes I say things that are very basic to me, and yet the clients don't understand it. And I get it. I mean, everybody works in a specific field. And you may know something that is like, my goodness, this is just, information 101. This is just rock bottom basic info. If you don't know that, what do you know? But yet to me, it may be like, I don't understand that. So we all have industry knowledge in our particular industry. And what I mean when I say closet index funds, it is a phenomenal, it's great for an advisor. Okay, let me explain it. What a closet index fund is a portfolio that you see significant diversification, that you see significant, diversification in your mind, but you see significant, statements that you own or investments that you own on your statement. So you may own, I'll give you an example. We had an investor that owned 400 stocks. And I'm thinking, my goodness, I mean, that is the classic example of a closet index fund. And what that means is it looks like there's real active management. It looks like there's real diversification. Yet it's just going to move with the market. You're going to move up with the market. You're going to move down with the market. And that's a closet index fund. And why are you paying for that? Because if that's how you want to invest your money, go to Vanguard, go to Schwab, go to Fidelity, whoever, and go and buy index funds, and don't pay an advisor a fee. Because if an advisor is not bringing anything to the table, then why are you paying them? And now on our side of the table, well, my goodness, that's a phenomenal way to live, right? You go and charge 1.5%, 2%, whatever that fee is, and you just put clients in a portfolio that is going to do nothing more than move with the market up and then explain away losses when the markets are down. Well, that's a darn good industry to live in, right? I mean, but you're not adding any value to the client's investable portfolio. I have yet to meet an investor, most investors that we work with that call us, they're not convinced that they think that their strategy can handle, for the most part, all markets, but yet they're not 100% concerned or convinced, so they want to have us look at it. And I have to tell you, I commend those people who can reach out to somebody that they don't know. So it takes a lot of courage to reach out to somebody. And in this, the old adage in life, if it's not broke, don't fix it. Well, last year was broke. This year, it's not so broke. But if we look at the market, but so many people are underperforming the market and missing out on meaningful returns. And what that means is when we see a correction, which we will, and it could be significant, you just don't have that airbag. You don't have that airbag in place. You don't have that margin of error where you saw great growth and And, so you've made a lot of growth, and there is some margin of error if the markets do go against us or go against you. So let us help you. And those that reach out, congratulations. I mean, it just takes, some courage to do it. And I'm really happy that, people are reaching out. And that's one of the reasons we're expanding the show, because what you hear on the radio is what you get when we talk. We have a great client base. We're certainly not hurting for clients. That being said, we do want to grow the business. We do want to help people. But what that means is if you have a good established client base, I don't care if you don't become a client. If I can't help you, I'm going to tell you. I don't have to put down what you're doing just to, try to get you to become a client. And that's just not how we operate. I mean, we have like I said, a very established client base, and we have a very good niche strategies that we use. And I can promise you it's probably going to add value for 9 out of 10 of you, because there are a handful of others out there that have, used the strategies that we utilize, except when it comes to the tax strategies. I've yet to see any meaningful amount of potential clients that reach out to us that have anything invested in their current portfolio that can greatly reduce their taxable income. So give us a call, 630-492-1912, 630-492-1912. So so when we look at risk and approaches to risk and approaches to market risk, there are people that want to avoid all market risk, and there are strategies out there that can help those individuals. And, there's, a couple of reasons that you want to consider, strategies that can avoid market risk. I do talk with a lot of individuals that just don't want to lose money, period. I think that, personally, I am okay with some risk, and because I like the potential reward if the portfolio is managed correctly and diversified correctly and incorporates strategies that, can, greatly reduce, potential major downfalls. But there are clients out there that just say, I don't want to lose money, period. I have X amount of dollars and it's enough for me, and I just don't want to do that. And reasons they're looking at that is certainly longevity, and inflation protection is something that we have to now be concerned about. And so for those investors that don't want any risk whatsoever, the good news is there's a handful of strategies that can work for you. And we have to, go over those strategies, because I don't want to see people tie money up unnecessarily in CDs. And, CDs, to me, why would we buy a CD when we can just leave it in the money market today? But there are strategies that compete very, very nicely with CDs. I mean, heck, you can get a managed portfolio of CDs that give you, some opportunity to make more than just a local bank. So when it comes to, avoiding market risk altogether, there are strategies out there. Most people fall into the classification of they want to limit risk and they want to transfer, the risk to a big financial institution. And those strategies are becoming incredibly popular today. And a lot of it's like the dual directional note that, we do, and in other income notes. People don't understand that you can you can structure a JP Morgan note or a Citigroup note or a Bank of America note or a Morgan Stanley or UBS note that, pays you 8% a year or 10% a year. And you get that as long as the markets don't go down 30 or don't go down 40%. They vary, but we can actually customize those notes for you. And it's a debt offering from the institution. I mean, that's whoever is underwriting it is backing it. And if we're in a sideways market, it's still very appealing and very reassuring to know that, you can make 10 with, as long, and you have 40% downside protection. So again, if you bought Microsoft in 2000, it took you 14 years to get back to even. Don't let that happen to you. Don't let that happen to your portfolio. Think about that. If you bought Microsoft in 2000, it took you 14 years to get back to even. That is a lot. That's a long time not to make any money and just get back to even. And it had a lot of stress during that period and a lot of euphoria during that period. But the ups and downs can kill portfolios. And so the defined outcome strategies are great. They're fantastic. And that's generally what we see. People who want to, limit risk or transfer the market risk to a larger financial institution. So let's talk about financial planning and income distribution when we come back. If you'd like to have a conversation this week, give Paige a call. She can set that up, 630-492-1912, 630-492-1912, or go on the website, kuhncp.com, kuhncp.com, and you can set that up on your own. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. Thank you for joining us this weekend. You are catching us potentially on Sunday as well. I think we got bumped with some football. I do love college football. I love the NFL. So what are you going to do? So if you're catching us on Sunday and you're not usually listening to us, welcome. If this is your first time, welcome. If you're a repeat listener, thank you for catching us. If you're catching us on the podcast, we do podcast every episode. Welcome as well. So we ask, if you are listening to the podcast and you see value in what we're talking about, what we're trying to educate investors on, I ask you to simply send it on to a friend or two, family member or two that needs to hear our message, because we are expanding the reach of the show. If you're listening to us outside of the Chicago market, rest assured that we're here to help you as well. So we're a fiduciary. Everything we do is to build hyper-personalized portfolios, especially when it comes to your unique growth, protection, cash flow, income needs. Everybody's different, and model portfolio cookie cutter strategies, unfortunately, just aren't going to cut it. So set some time up with Paige this week, and we can have our conversation. Initial conversation is great, very informational, share with you what we do, what you're looking for. If we can help you, then we're going to suggest a portfolio review. It's complimentary, but it gives us an idea, and it'll give you an idea of the strengths and weaknesses of your current portfolio. So give Paige a call, 630-492-1912, 630-492-1912, or set it up on your own. We can do that on our website, and that website is kuhncp.com, kuhncp.com. So talked a lot this week. Obviously, spending a lot of time on risk management, dual directional notes, and strategies that you can make money if the markets are down, strategies that are significant tax advantage strategies. And again, if any of those interest you, please set some time up so we can have a conversation this week, so we can educate you on those strategies. Conflicts of interest, we touched on those briefly. I do want to make sure that you understand that there's a very, very good chance that you have what we consider a closet index fund, which is a portfolio that's just going to go up and down with the market. And that is very, very dangerous at current valuations, at current levels, geopolitical risks coming into an election year next year. You have to make sure that you have your portfolio buttoned up. You have to make sure that you have strategies that can make money when the markets are down to a point. I want you to hear that, please. You need to include strategies that can deliver positive returns even when the markets are down. And those are things that we want to make sure that you are incorporating, because you're not giving up much or anything on the upside. It's just really time. And these strategies are very short duration, 12 months, 15 months, etc. So if you don't have those in your portfolio, the question is why? Technology evolves, investing evolves. Defined outcome strategies that we know going in before we invest, what our upside is, how much money we can make in a down market, and then when do we start to lose money. So 630-492-1912, 630-492-1912. Give Paige a call and set some time up for us to have that initial conversation. Financial planning. Financial planning is interesting. We look at financial planning as a flight plan. Okay. You would not get on a commercial airline if they didn't have a documented filed flight plan, that you knew the parameters beforehand. And that's kind of how we look at a financial plan. Financial plans are great. They're important. They're just really a way that we can benchmark our progress. Most people don't, like I mentioned earlier in the first segment, we met with somebody over the last, month or so that had a multiple 7-figure account and they were up, under 2% for the year. Well, I don't think that they knew that. And I don't think that they realized that they were giving up 14% to the market. And so a financial plan with regular check-ins would help that investor, would help, educate that investor that, listen, you're not even keeping up with money market rates. And again, it's not the investor, it's the advisor. And so one of the things with the financial plan is it really just provides you with regular check-ins, and it provides you with you can really look at and see where the market is, because a lot of times people will say, well, you don't want to keep up with the market. That's not your goal. Of course. It very well may be. But if you look at history and what numbers tell us, the average investor is greatly underperforming the market. Yet the average investor wants to talk about, well, what's your fee? That's like a lot of times the very first question out of people's mouths, because you've been conditioned to, for that to be the only consideration of working with someone. What's your fee? Well, it doesn't really matter what my fee is. Are we adding value or not? Let's talk about what our after fee returns are. I think to me, that's the most important thing is after you pay a fee, what is your net return? And so some of the best investments are the most expensive, and some of the best investments that can, reduce your taxable income the greatest are the most expensive. Some of the best investments that can and historically have done incredibly well in down markets and made you money in down markets are the most expensive. So, just because you're paying, I look at fees like, if you could go and lose your own money and not pay a fee. Last year the markets were down 23, 24, 25%. If you didn't pay a fee, well, that was really your fee. So we want to change the conversation. And when it comes to financial planning, and people are still using for distribution purposes, probability analysis. I'm sure you've seen a financial plan that showed you have a 90% probability of meeting your goals and objectives in retirement if you take out X percent a year. Well, okay, fine. Statistically, that is very good, but what happens with that other 10%? What about those other outliers? 2000 to 2003 was an outlier. 2008 was an outlier. 2018 was an outlier. COVID was an outlier. Outliers happen. And so that is antiquated ways to look at, distribution planning. And if you've talked with us, our Income Lab software is just absolutely phenomenal. So if you have over $100,000 and you're concerned about, or you want to maximize, your distribution, let us show you that software. So 630-492-1912, 630-492-1912. Get with Paige. We'll talk more about that after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. I am the host of this show. My name is Robert Kuhn. I'm also the president, founder of Kuhn Capital Partners. We're independent. We're a fiduciary. We are a registered investment advisory firm. We build hyper-personalized portfolios for every customers and clients and partners. Call it what you want. We look at it as partners. It's funny. Sometimes I have, other friends in the industry, and it'll be like, I have a customer coming in, or I have a client coming in. We like to say we have partners coming in because we are a partner. A partner is how we view ourselves in our relationship with our investors. We're partners. That's why we named the company Kuhn Capital Partners. So our custodian is Charles Schwab. Charles Schwab doesn't vet us. They don't say we're good or bad. They are just our custodian. And what that means is all of your accounts are held at and custodied at Charles Schwab in your name. So we're simply the advisors on the account. So we strongly recommend that if you want hyper-personalized portfolios, if you want custom portfolios, if you want tax advantage strategies, significant tax advantage strategies, if you want strategies that you can make money when the markets are down, working with an independent registered investment advisory, generally speaking, is going to provide you access to more strategies, more investment options, more customized, personalized planning than working with the big bank or a big brokerage firm. It's just simply how the numbers work. And really, it comes down to compensation. We can have less clients and make more money because we're not sending 60 cents, 70 cents, 80 cents of the dollar up to the big bank or the big brokerage firm. So if you want customization, you want personalization, you want access to strategies that can greatly reduce your taxable income, you want to work with a fiduciary, give us a call. Let's have a conversation. Let's talk about our reports, our planning, and our strategies. And really our strategies, generally people reach out because they hear us say we have strategies that can make money in down markets. And those are the strategies that pique people's interests. And we certainly will go over that with you. So give Paige a call this week. Let's have our initial conversation, 630-492-1912, 630-492-1912. Or visit the website, kuhncp.com, kuhncp.com. And we'll get to it because, obviously our job is to make sure that you're aware of what you own, what you don't own, what your risks are, before a outlier happens. And we were talking a lot about kind of financial planning. We were talking about distribution planning, a couple things in the industry that the financial advice industry hasn't done well. I think in a lot of ways it's broken. We haven't talked, well, we do, but the industry hasn't talked about how losing money is so detrimental. They just want you to think that it's okay to lose money if you have 10, 15, 20, 30-year time horizon, 40-year time horizon, 50-year time horizon. Well, I mean, is it okay because you have a 20-year time horizon? Is it okay if you have a 50-year time horizon? What about those individuals that have a 10 to 15-year time horizon? What if we see a 2008, right now, and you don't have any risk protected strategies inside of your portfolio? And hear me that in a lot of instances, you're not giving anything up on the upside. I mean, there might be a cap on the upside of your growth, but like the dual directional note we did last week, 15 months, your max gain was 22%. I mean, I think you'd be hard pressed to see the S&P or the Russell be up 22% from these levels in another 15 months for that trade off of that, maximum gain of 22%. You made money when the markets were down 0 to negative 15. You got the inverse return. So negative 15, you were positive 15. So those strategies exist. Again, there's pros, there's cons. It has to incorporate into an overall plan. It may not make sense for you. So I want to make sure that we're giving you all of the necessary disclosures because they're real. But, strategies like that exist. So 630-492-1912. So financial planning, real quick. To get back to the probability. Okay, well, that's where I was going. Sorry. If you've listened to the show, sometime I go down some rabbit holes, but we were talking about deficiencies of the financial advice industry. So number one, closet index funds. Number two, lack of transparent, tax efficient strategies that can greatly reduce your taxable income. And number three is thinking it's okay to lose money. And, the markets on average are up 7 out of 10 years, right? But again, what if we have those 3 years at the wrong time? Everybody's, we call it the retirement red zone. Everybody's retirement red zone is different. So what if we have those 3 down years at the wrong time? That could greatly affect the longevity of your assets or just unnecessary stress, right? And so those are the things that we want to mitigate. So, and then we look at, so it's not okay, in my opinion, to lose money. We want strategies that can do well. So the industry hasn't done a good enough job of explaining just how detrimental losses are. And I promise you, with the firm's money, with their own money, that's all they're thinking about. I mean, just thinking about not losing money. And then really lack of diversification. People still think stocks, equities, and fixed income and cash are a diversified portfolio. There are huge firms out there that's all they offer. And, it's a challenge and it's unfortunate. So, we think when you look at managing money, we have to have strategies that have different return drivers. And here's the beauty of it. If you want help, we can help you. Those are the things that I want you to fully understand, that if you're open to receiving help, then we're going to work with you. If you have $100,000, if you have $10 million, we're going to help you. Intellectual capital is going to be the same. Strategies may differ. I mean, certainly the more money you have, the more access to other strategies that, other people, they don't have. That's not my rules. It's just the rules of the industry. But we're here to help. And so I want to make sure that, that, we just don't want to see you lose money unnecessarily. So give Paige a call, 630-492-1912, 630-492-1912. We are going to start doing workshops throughout the Chicagoland area. And if you're listening to the radio show outside of the Chicago area, we're going to start doing workshops in your area as well. I haven't figured out how, I don't want people just to come for dinner, right? I mean, that's the industry. You send out 10,000 mailers, put a nice big steak on it, and I can fill a room of 100 people tomorrow. And it's nice. I mean, we certainly want to, have some refreshments, but we want to have people who want to learn. And so I don't want the driving factor to be, I want to, have the greatest steak at the latest steakhouse. We want people to come to a workshop that really is not convinced that they have the right strategy in place for them, that they don't have the right distribution strategy in place, that they don't have strategies inside of their portfolio that can make money when the markets are down, that they're concerned about inflation. They're concerned, about the geopolitical risks. They're concerned about the valuation in the current market, that we've just really been very range bound, but yet, their portfolios haven't gone anywhere. I mean, seven stocks make up 73% of the growth of the market so far this year. So it has been a very thinly traded market. So stay tuned for those announcements, but we're going to kick those workshops back up in the fall. So we're really excited about that. So I want to thank everybody, obviously, for listening to the show. It means a lot. We see the podcast numbers. They're up and to the right. We like that. Our only ask of you is, if you're not convinced that you have a portfolio that can, address all of the challenges that I've spoken about on this show and past shows, give us an opportunity to help you. At least give us an opportunity to educate you, because I'm a firm believer that if we can educate and we can not talk over your head, and if we can really show you the strengths and weaknesses of your portfolio, ultimately you're going to be able to make a good decision that's right for you and your family. So give Paige a call this week. We can have that conversation, 630-492-1912, 630-492-1912. You can also go to the website, kuhncp.com. kuhncp.com. You can schedule a time there as well. So whatever's more convenient, make it a great week. We'll be back next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.